Hello. We would be talking about the basics of money markets today. Let's look at the agenda for this section. We would be introducing to you what are really money markets, talk about the various segments and the participants in the money markets. Let's also talk about some of the instruments and how is really interest calculated for these instruments. Let's start with defining what are money markets. Money markets are a part of the global financial markets where money is lent or borrowed for a very short period. So essentially, it's a short-term lending and borrowing. Money market participants are governments, financial institutions, banks, and large corporate houses. Households do not really participate directly in money markets. The period of funding is short term, which means that money is lent or borrowed for a short period, and this could be less than 1 year. Money is lent or borrowed for as less as one single day, going up to 1 year. Let's look at the various segments within the money market space. Money markets can be segmented in 4 different ways. The first one, the interbank market. Let's try and first understand how the banking business works. The banks on one side accept deposits from people who have the money, and on the other side loan it to people who want the money. Also, banks are required to maintain certain reserves with them. Now, in this entire process of money being deposited by depositors and on the other side being loaned to people on the other side, banks are in a deficit or a surplus position. When they are in a deficit position, they are required to borrow money, which means that banks who need money will go to banks who have the money and borrow for as less as one single day. This is broadly the interbank market. Primary market is the first time issuance of the money market instruments. Corporate houses, governments, financial institutions issue securities to raise money. The secondary market is the day-to-day buying and selling of these money market instruments. Some of the money market instruments, which are for a period of say 1 day, may not have an active secondary market. The derivatives market is basically the financial contracts based on the money market instruments. Let's look at how is interest calculated for this short-term lending and borrowing that takes place. In a money market instrument, the lender is lending money to the borrower, and the borrower at the end of the decided period will return the money along with some interest. Now, when we say that this lending and borrowing is for less than 1 year, how does interest really get calculated? The period would be less than 1 year, so the actual number of days for which the loan has been given will have to be taken into consideration. This is called as the day count convention, which means that actual number of days divided by either 360 or 365 is taken into consideration. Some markets take 360 days, whereas some markets take 365 days. Let's take a numerical example to understand this better. Let's say we have a loan of euro 10 million. The period is from 15th of July until 15th of October. And the interest is 5.75%. If you look at the period from 15th of July to 15th of October, that comes to 92 days. When we calculate the interest for 92 days, taking into consideration 360 days, it comes to euro 146,945. This is how interest is calculated for that particular period. Let's also introduce to you another way of issuing the money market instruments. In the first example, we have seen that party A loans $1,000, let's say, to a party B. Party B, at the end of the period, will return back these $1,000 and also, let's say, pay 5% interest, that would be $50. So what is given away is $1,000 and what gets returned is $1,050. In other way of looking at it, let's look at it the other way. What if party A deducts the interest upfront at the start of the period itself, deducts these $50 and loans $950? The borrower, party B, will have to pay back $1,000. So here there is no separate element of interest being paid, but interest is deducted upfront at the start of the period. This is called as zero coupon security. We will be talking about the zero coupon securities later in this section. Now let's try and understand what are the various instruments available in the money markets. They are the call money, the treasury bills, commercial papers, and the certificate of deposits. Let's examine each of these in detail. The call money or the notice money is broadly the interbank market. As we spoke about earlier, banks lend and borrow for as less as one single day. If the money is lent or borrowed for a period up to 14 days, that would be called as notice money. Certificate of deposits. Certificates of deposits are basically negotiable instruments issued by the banks. Let's talk about the interbank lending. The call money or overnight money could be lent or borrowed for a period of one single day. The same thing, if it's done over the weekend, would translate into weekend money. We talked about it earlier that if the money is lent for about 14 days, that would be notice money. But anything beyond that would be termed as term money. And intraday, as the word suggests, is lending and borrowing during the day. So money is lent at the start of the business hours, but before the end, it's repaid back. Let's look at other instruments like treasury bills and bills of exchange. Treasury bills are issued by the government, but governments do not directly issue these securities. They would do it through the central banks. Central banks issue treasury bills by way of zero coupon securities. Let's say, for example, the US government issues a $1,000 treasury bill. But if the interest is, let's say, 5%, then they would deduct this interest and they will have to issue this at, let's say, 960 or 970, depending on the interest rate in the economy. Bills of exchange are nothing but instruments where one party promises to pay the other party an amount after a fixed period. Commercial papers. Commercial papers, as the word suggests, are issued by companies or corporates. Corporates have short-term working capital requirements. They need money for their day-to-day functioning. They might want to borrow money for a period of 3 months, 6 months, 9 months, or 12 months. On the other hand, repo and reverse repo are not really lending and borrowing, but really selling and buying of securities. In a repurchase agreement, party A sells a security with the promise to buy it back later. So for the party who is selling it first and buying it later, it would be a repo. But for the other party who is buying the securities with the promise to sell it later, it would be a reverse repo. So we have seen some of the instruments under the money market space. Let's summarize the learnings. In this section today, we have talked about what are really money markets, what are the various segments within the money market space, the participants in the money markets, and also examined some of the instruments under this section. Thank you.